Hello and welcome to the Small Business Briefing. I'm Brian Kelly, CEO of the Small Business Association of Michigan.
Hi, good afternoon. Thanks for tuning in today. I'm Sarah Miller, SBAM's Vice President of Marketing and Strategic Communications. Brian, on Monday's show, you kind of teased out that we'd be looking for some new data and numbers this week. I know you're going to cover a lot of that on Monday for Data Monday, but let's talk about inflation. New inflation numbers were released. What do they show?
Yeah, it wasn't a particularly surprising report, but unfortunately, it was not surprising in the sense that it does show that this substantial decline in inflation rates that we had been seeing is kind of stalled out. So it's kind of stuck. Just looking at the numbers, if you annualize the rate of inflation in February, it was 3.2%. In January, it was 3.1%. So actually, just slightly higher on an annualized basis than the previous month. So we had seen just a steady stream in the previous year of just every single month it was coming down, even if it was only coming down a little, or was staying even. It was going down. The idea that it kind of flattened out and then actually went up a bit is again not really unexpected. I feel like that was kind of being forecast, but disappointing that that was the case. So and then if you've been watching the briefing and part of this discussion over the course of the last few years, you know that there's the consumer price index, so that top line inflation number, there's everything in it. You strip out the commodities of gas and food. The inflation came in at what they call core inflation at 3.8%, which was a little bit higher than what most economists were forecasting. So both of them, not like way out of the realm of what was expected, actually pretty close to what was expected, a little higher than what was expected, pretty close, but just disappointing that it just kind of seems to have hit a bottom and stalled out, and not at the level, they like to see at 2% or maybe a little less. The fact that it stayed, you said, well, 2% is not that much higher than or 3 is not that much higher than 2, but the problem is that the labor market is still so hot. The shortage of people is still so acute that and in the service industry in particular, there's so much like upward pressure on costs that there's just concern that it would be one thing if it hit 3 and people thought, oh, let's just stay there for a while. The concern is that it starts going back up, and of course that would be pretty alarming to see a real upward trend from here. It's something that clearly the monetary policy makers are starting to look sideways at these numbers, and they have a lot less confidence that they will continue to go down, and therefore are kind of projecting trying to set different expectations over the course of the next year.
So let's talk about what this might mean for the possibility of an interest rate reduction in the future.
Yeah, the interest rate picture has gone from like hopeful reductions in interest rates in the spring and then throughout the rest of the year to very little expectation that there'll be any reduction in interest rates in the first half of the year, and kind of pushing off, like, if everything goes as I'll say planned or hoped for the first half of this year. In other words, rates continue to start to continue going down again, then interest rate increases would be back on the table. But expectations of any cuts for the first half of the year have basically evaporated. I have a quote here that let's see. We don't want to Jerome Powell, the chair of the Fed. He said, we don't want to have a situation where it turns out that the 6 months of good inflation data we had last year didn't turn out to be an accurate signal of where the underlying inflation is. And so, in other words, it's that, yeah, it has gone down, but the upward pressure is still there. They haven't eliminated the pressure of inflation pushing costs up. But I had also tried to kind of like counter that with still some confidence, that when that while they're not confident right now that inflation has come down enough, that quote, we're not far from it. So, in other words, they're close to being confident. Okay, so these words are crafted very carefully when they come out of the Fed. They know that the markets and like the stock market and investors are just hanging on every word that they say. So they take very special care in the words that are said. And so I think in this case, they're trying to basically say, we just need to wait for a while and see. They're not overly concerned that rates are going to start going up, but they're not confident enough to um, that they're going to continue to go down. Therefore, status quo for a while.
All right, let's switch gears and talk about politics. And in kind of unsurprising news, it looks like the 2024 presidential election is going to be a 2020 rematch.
Yeah, that's locked in now. I mean, unless something were to happen to Joe Biden or Donald Trump, they have now secured enough delegates to their respective conventions to secure the nomination. So there's nobody else that's in the running for that. Or really, practically, they've had both of them have had their nominations locked up for a while, but now it's official. There have been enough state primaries, especially with Super Tuesday, and then a week later with another round of states. There's enough delegates to where they, without any other wins of any other state primaries in the future, and there's still a bunch of them, and no real opposition, they have enough to secure the nomination already. So they've technically now clinched those nominations, which means that it will be a 2020 rematch. The what there now let's talk a little bit about running mates. There was with Vice President Harris, there was a little bit of chatter a few years ago about whether or not they'd put somebody else on the ballot to run. There's no chatter about that anymore. So it seems like that half of the ticket set. President Biden, Vice President Harris are the are going to be the ticket again, unless something were to happen to one of them between now and then. The and then with now on with Donald Trump, and obviously it's not going to be Mike Pence like before. So there'll be kind of intrigue around a potential running mate, presumably over the coming months. But that there wasn't a lot of drama in it. But I thought worth noting that that it's been clinched on both sides. Both happened on the same evening. Both had kind of similar rates of success through the big contests that happened since then. So Michigan had an early primary this year. There was some consternation about whether or not on the Republican side they would give up delegate strength at the convention for going earlier than the national rules allowed. Turned out it didn't matter that happened, and so now really the next like there'll still be a bunch of contests, but basically this election will take on the look and feel of a general election now. So before, when there were other kind of candidates somewhat in the mix, that's not the case. Now there is an independent candidate, Robert Kennedy, who has had some success getting on the ballot as an independent in several of the states, and I think is well. Yeah, I don't think there's anybody projecting that he has a real chance of winning. There is some concern especially among Democrats, that he could be a spoiler for President Biden. Now, my experience though is that independent candidates actually do draw from both parties, even though Robert Kennedy was a Democrat in Congress. He does have he's kind of carved out an independent persona, and I expect he actually probably will. I don't think he's going to get a huge percentage, but I think he's probably going to draw from both sides and kind of not play the role of a spoiler. But essentially, everything about this campaign is going to look and feel like a general campaign heading out. And then, Joe Biden again in Michigan this week. The You will not be able to miss this campaign in Michigan. It is more and more shaping up to be a must-win for both candidates, and you'll have plenty of opportunity to see them speaking in Michigan and to issues that matter in Michigan.
All right, speaking of President Biden, during last week's State of the Union address, he threw out a statistic on the average tax rate of the top 1%. So there's been some reaction to this. And so, Brian, can you talk a little bit about what the tax burden actually is at the different levels of income?
Yeah, there was whenever I hear, well, I'm going to tell you what the top 1% really means in terms of income level. But even if you were to look at, um, top 2% or top 3% or certainly top 5%, it starts to include a lot of small business owners at those income levels because pass-through income. So S corporations or um, or LLCs, partnerships, that all of that business income is taxed at the individual level, and so many small business owners can present, if you look at the tax returns, or so they have really high income, and including the business, they do, relatively speaking, but it doesn't mean that they took money out of the business and paid themselves. So in most cases, they didn't. It's just the way that the income gets taxed. So the president had said that people that made that level of income, by the way, so top 1% is 680,000 or higher. So that's kind of the cutoff. So basically said that they only pay federal taxes of 8%, and so it's not a fair share, if you will. That was kind of raised a lot of eyebrows. People that make that kind of money were like, wait a minute, I pay a lot more taxes than 8%. Where do you get that from? So I just want to go through kind of a series of things, so paint the picture, get an idea of what the overall tax burden is and where it lives in terms of who the payers are. So starting at that top, so top 1%, 108 or 680,000 or more. That accounts for 26.3% of all income earned in the U.S. So that 1% makes about a quarter of the income, but pay about 45.8% of the taxes. So it is a lot of concentration of income, but a bigger concentration of taxes. So that 1% pays almost half of the taxes that the federal government receives. Now, if you're to kind of look right down the middle, say top 50%, so people in the top half of earners, that's actually 47,000 or above. I was a little bit surprised by this number. So I would have thought the top half would have started at higher than 47%, but it starts at $47,000. So 47,000. That includes 89.6% of all income made in Michigan. So almost 90% of income is made by the top half of earners. And if you think about that, it kind of makes sense when like kids don't have any income. A lot of, there's a lot of like a single member house or single income household. The spouse doesn't like, so it makes sense that you have a whole bunch that maybe have zero or close to zero students, and kids don't start working till later, all those kind of things. But anyway, so that 89.6% of the income paid 97.66% of all taxes, and then so almost all taxes are paid by people who make 47,000 or more, and then let me see here. So comparison to 1980, because there's been this talk about like income has become more concentrated in this generation. That's true. That the amount of income that people at the upper echelon of income make is more concentrated than it was a generation ago. But but the tax burden was less. Uh, just to give you a sense, a tax burden is um, the rate is less today, but the concentration of taxes at the top is higher than it was in 1980. So in 1980, the top 1% paid 19.3% of personal income taxes. And the highest marginal tax rate, by the way, was 70%. Another thing I was surprised at, I didn't know that the US in 1980 had a top marginal tax rate of 70%. So the top 1% paid 19% of personal income taxes back then. Today, they pay 45%, 46% almost, and and the rate was in the marginal federal income tax rate at 37%. So that's a just kind of a snapshot of these different brackets. And so, I think there is credibility to say, look, at the top, there's been more concentration of wealth at the top, and that's true. But I think especially true at the very, very tippy top. Even if you say 1%, but if you're to look at the top, like 0.1%, because there's like 1,000 billionaires now in the U.S. So like there's a concentration, but it's not actually with most of the 1%. It's just it's with the top 10% of the 1%. That this tax burden question always comes up, and the incremental tax rate on those higher incomes is it's 37% now. I mean, so that's why I think there's some I don't know, some criticism like that 8% is not a real number. So where do they come up with the 8%? What's believed that they do is they'll take people that own big shareholders. So I'll just use big shares in big corporations. I'll use kind of the most famous example of Elon Musk. So he owns Tesla, or a big share of Tesla. So as that stock goes up and appreciates, if you count that as income, but that's not taxable income. It's like if you own a thing and that thing you own gets more. I own this phone. Okay. If this phone got more valuable, it wouldn't be income on my tax return. The phone just got more valuable. Doesn't. It depreciates to nothing very quickly. But like with stocks, but you only pay taxes when you sell it. And so if you have something that appreciates in value, but you don't sell it, then it's not taxable income. And what I believe they're doing is they're saying, oh, some of these really rich people have big shareholder income, but there's no dividends paid. They haven't sold the stock. It's just what it's trading at right now is what it is higher than it was before. And there's no taxes paid on that. So if you were to kind of include that as income, just like as though it were income, then the marginal tax rate would look a lot smaller. I think that's what they're doing when numbers like that are thrown out. But it's not. I always, the reason that I'm a little bit protective on this is because so many of our members can look like they have hundreds of thousands of dollars in income on their personal tax returns because of these flow through entities and all the business income, even if they can't really afford to pay themselves much of a salary. And so I think it bears explanation that there's a lot of small business owners that on paper look like they have a lot of income, but they don't have cash flow or personal income that they can draw out of the company because it just takes so much to feed the company everything that it needs, and pay a lot of taxes. So that's why I say a number like that gets thrown out, the 8%. I'm just kind of like interested to figure out like where did that come from, because it's just not, it doesn't tell the whole story. At least when it comes to entrepreneurs or small business owners, it is absolutely not representative of the type of tax burden that they have to carry.
Well, thanks for your perspective and doing the homework and explaining it to all of us. Let's talk about the IRS treatment of hydrogen hubs, kind of a hard pivot here. But the IRS is treating hydrogen hubs in Michigan differently from some other zero emission type companies. And it's kind of illustrating the difficult and complex trade-offs we have as we try to move towards zero emissions. So can you fill us in here?
You might remember that there was a lot of kind of fanfare of huge tax incentives to move toward more zero emission and green style energies, hydrogen or forms of energy. Hydrogen is one of those things, like a zero emission fuel. And so in Southeast Michigan, there's one of these designated hydrogen hubs, but the whole business model relies on the federal government making good on very, very large tax credits to kind of get these things up and running. And so the IRS has, though, issued some rules that or some limitations on it that that have really changed the landscape there. And I think it really illustrates how difficult and complex the transition in energy uses could really be. Because what the IRS is saying is you you can't use fossil fuel in the development of this. If you know, like that, you can take yourself out of qualifying in the development if you're not if if you're if you're using fossil fuels to kind of like run the center. So like electricity, for example, is for these hubs is really an important ingredient. And what if the electricity is based somewhat on fossil fuels, which it probably would be? Or what they're saying is that even if you pull down, like, you know, you buy green energy credits, but they're not nearby and it's like a paper transaction, then it would limit the amount of green electricity that's available, renewable generated electricity, and therefore push the price up of electricity, supply and demand, which, yeah, that's probably what would happen. The And so there's all these complexities where the federal regulators are saying, wait, we don't want these trade-offs. We want it to be pure, but it's not feasible for it to be, at least not right now. And the reason I think this is kind of raising eyebrows, like where they're treating hydrogen, saying, "Oh no, you can't. You got to consider everything that happens in the whole life cycle of the development of this network." And there's a lot of fossil fuels that will be potentially used. So the IRS saying, "Okay, no, you can't. You don't qualify if when you take all that stuff into consideration." Well, the same is true about batteries. You know, batteries use a lot of energy. It takes a lot of energy to make a battery, and so like the idea of electricity and electric everything, but especially electric vehicles. If you were to apply the same standard that the IRS is applying to the hydrogen hubs, it could really mess up the business models that were developed around these federal tax incentives. So I think it's just an illustration that the deeper that the government gets involved in trying to incentivize these things, it exposes difficult trade-off decisions that have to be made, and this is just one of them. And it's one that really there hasn't been a lot of talk about hydrogen. It was like a lot of the conversation a few years back kind of dropped off the radar, but it's still a very, very active area of research and development when it comes to alternative forms of propulsion and energy. So keep an eye on where that lands. But I mean, the IRS sent out their rules, so I mean, it is what it is at the moment. And if it stands how it is today, it would significantly limit that type of energy development, at least when juxtaposed to um, the battery and electrification drive.
All right, before we say goodbye today, I do want to let everyone know about an upcoming webinar and then an upcoming webinar series. So next week we have 10 steps to enhance efficiency and grow your bottom line. That's next week, Wednesday, and you can learn more at sbam.org/events. And in April, we have a 3-part webinar series focused on social enterprise. And so you can register for 1, 2, or 3. You can register for all 3 of them. And the first one's going to be hybrid and for-profit social enterprise models. Then the next week we'll do building a brand in a consumer conscious world. And we'll follow that up with the business case for DEI and how it relates to social enterprises. And these will be kind of a two-part, each week we'll have a two parts to the webinar. We'll do education and then we'll have time for roundtables and discussion. So you can learn more at sbam.org/events. And Brian, can you just talk a little bit about the why and why we're, digging into the social enterprise area?
This is something that first of all, we're hearing more and more about it. More businesses are projecting what their kind of social mission is, or the community good that they're creating. And it takes a lot of different forms. It might be somebody that says, I'm going to take a certain amount of profit or a certain amount of my sales and put toward this community need or this kind of social need or this good out there. It could be that the business itself, the purpose of the business was to solve some sort of a social way, but use capitalism to do it, a social problem, but use capitalism to solve that problem. And so we really did want to dig into that a little bit, as we had seen more and more of this happen, especially with like newer generations of business owners that are thinking in this way. And for us, it's actually not that big of a leap. As we know, even with a lot of like small business owners are typically the business is in the community where they live. You're integral leaders or members of that community. They're leaders in that community. They're supporters of that community, kind of ingrained in the local community. So this idea of like the business creating, general good for the community is something that's just how small businesses have always operated. This is really more of that kind of like intentional forward um, projection of the business, and it can go to how the business operates, how it's organized, or what the purpose is behind the business. So we just find this to be a very, very dynamic part of the economy, especially with younger entrepreneurs, and and something that we wanted to really kind of lean into, and to do so in a partnership with another association, a strategic partner that's already a strategic partner of SBAM, and and to just kind of open the door on having a more intentional and direct conversation and programming around this style of business, which seems to be a growing segment of the small business community.
All right, thanks for adding that context. That is everything we have for you today. We appreciate you tuning in. We will be back here Monday at 3 p.m.
Thanks, everybody. See you next week.